Hello and welcome to our special feature today. We're tackling a topic that affects millions of senior citizens across the United States: car insurance. Have you ever wondered why your auto insurance premium starts to climb as you get older? Even if you have a spotless driving record, you're not alone. Many seniors overpay for their car insurance, often without understanding why. In this script, we're going to take a deep dive into why this happens. We will explore the statistical reasons insurers often view senior drivers as a higher risk. We'll also uncover lesser-known practices like price optimization, where your loyalty can paradoxically lead to higher costs. But don't worry, we aren't just here to present the problems. Our primary goal is to empower you with solutions. We will arm you with the tools and knowledge you need to take back control of your car insurance. We'll show you how to hunt for discounts, adjust your coverage to fit your current lifestyle, and even leverage technology to save money. So, settle in, because this information could have a major impact on your wallet. Part 1. The problem. Why do seniors pay more as we age? We're often rewarded with discounts and respect in many areas of life. But when it comes to car insurance, the story is frequently different. While drivers in their 50s and 60s may enjoy some of the lowest rates, premiums can begin to creep up after age 70. Let's explore the primary reasons why seniors find themselves paying higher premiums. 1. Age-related risk perception. Insurance is all about risk. Companies use vast amounts of statistical data to predict how likely a particular group is to file a claim. Unfortunately for senior drivers, the statistics aren't always in their favor. Increased accident risk. Studies from organizations like the Centers for Disease Control and Prevention (CDC) and the Insurance Institute for Highway Safety (IIHS) show that after a certain age, particularly over 75, drivers have a statistically higher risk of being involved in accidents. This can be due to natural physical changes such as slower reaction times, declines in vision or hearing, and shifts in cognitive function. Increased severity of injury. Another crucial factor is that when seniors are involved in an accident, they are more likely to be seriously injured or killed. The body becomes more fragile with age, and a minor collision can result in severe injuries, leading to expensive medical costs. Insurance companies charge higher premiums to offset this increased financial risk. It's vital to note that this isn't about your individual driving ability, but about large-scale statistical risk. Even with a perfect driving record, you may face higher rates simply due to your age. Point 2. The loyalty penalty. It sounds counterintuitive, but staying with the same insurance company for years can actually cost you more. This phenomenon is known as the loyalty penalty or price optimization. How it works: insurance companies use data to analyze which customers are less likely to shop around and switch. If you're a loyal customer who pays your bill every year without question, the company may assume you aren't sensitive to price increases. They may begin to gradually raise your premium, betting that you won't go through the hassle of looking for a better deal. Why it's unfair? This practice is based on your shopping behavior rather than your driving risk. It means to people with identical risk profiles could be charged different rates, simply because one is more likely to shop around. Some states have started to ban price optimization, but it's still a common practice in many places. 3. Unknown discounts. There are numerous discounts available for seniors, but many drivers simply don't know about them. If you don't ask, you're probably not getting them. Specific senior discounts. Many companies offer mature driver discounts for drivers who reach age 55 or 60. Other common discounts. Low mileage. A good driving record, safety features in your car like airbags and anti-theft devices, and bundling policies like home and auto can all lead to significant savings. The problem is that these discounts aren't always applied automatically. Insurance companies may not actively advertise them, making it easy for seniors to miss out on the savings they deserve. 4. Lack of comparison. Shopping for car insurance can seem like a daunting task, especially if you're not familiar With the process, many seniors prefer to stick with their current company because it feels easier. The assumption there's a perception that all companies offer similar rates, or that the process of switching is too complicated. The consequence, not shopping around, means you are almost certainly leaving money on the table. Rates can vary by hundreds or even thousands of dollars from one company to another. For the exact same coverage, without comparing, you have no way of knowing how much you're overpaying. 5. Changing driving habits. Retirement often brings major lifestyle changes, including driving habits, less mileage. Many seniors no longer commute to work, resulting in a sharp drop in annual mileage. If your insurance policy still reflects the higher mileage of your working years, you're paying for miles you no longer drive. Avoiding riskier driving times. Retirees can often avoid peak rush hour traffic and nighttime driving, which lowers their accident risk. If your policy hasn't been updated to reflect these changes, your premium is based on your old lifestyle, not your actual driving habits. Part 2. The solution: how can you lower costs? Now that you know why seniors often pay more, let's move on to the most important part: what you can do about it. Taking control of your car insurance is easier than you might think. Here are practical steps you can take today. 1. Shop around. Shop around. Shop around. This is the single most important step you can take. Do not be loyal to your current insurance company unless they have proven they are giving you the absolute best rate. Get multiple quotes. Aim to get quotes from at least 3 to 5 different insurance companies. You'll want to include both national giants and smaller, regional insurers. Use online comparison tools. Numerous websites allow you to get quotes from multiple companies at once, making the process much easier. Talk to an independent agent. An independent insurance agent represents multiple companies and can do the shopping for you, finding the best coverage and price for your needs. When you're comparing quotes, make sure you are comparing identical coverage levels and deductibles to get an accurate apples-to-apples comparison. 2. Ask for discounts. Never assume that discounts are applied automatically. Call your insurance agent and specifically ask about these discounts. Mature driver discount. If you are over 50 or 55, you may be eligible. Defensive driving course. Organizations like AARP, AAA, and the National Safety Council and SC offer state-approved driving safety courses. Completing one of these courses can earn you a discount of 5% to 15% that can last for several years. Low-mileage discount. If you're retired and driving less, tell your insurance company. Many companies offer discounts for those who drive below a certain threshold, often less than 7,500 or 10,000 miles per year. Good, safe driver discount. If you have a clean record with no accident or violations for the past 3 to 5 years, you should qualify for a significant discount. Bundling multi-policy discount. Bundling your car insurance with your home, condo, or renter's insurance policy through the same company often saves 7% or more on your auto policy. Membership discounts. Are you a member of AARP, AAA, or another senior organization? Many insurance companies have partnerships with these groups that offer special rates. For example, AARP has a well-known partnership with the Hartford that provides exclusive benefits and discounts to members. Vehicle safety discounts. Cars with features like airbags, anti-lock brakes, daytime running lights, and anti-theft systems can earn you discounts. 3. Review and adjust your coverage. Your insurance needs change over time. The coverage that made sense for you 10 years ago might not be necessary today. Raise your deductibles. Your deductible is the amount you pay out of pocket when you file a claim. Raising your deductible, for example, from $500 to $1,000 can immediately lower your premium. Just be sure you choose a deductible amount you can comfortably afford. Drop coverage on older cars. If you are driving an older car with a low market value, it may not make financial sense to carry collision and comprehensive coverage. A general rule of thumb is if your premium for these coverages is more than 10% of the car's value, you should consider dropping them. Check your liability limits. make sure you have enough liability coverage to protect your assets. In retirement, protecting assets like your savings and home becomes even more crucial. 4. Consider usage-based insurance. See if you're a safe driver who doesn't drive very much. Usage-based insurance (UBI), also known as telematics, could be a great option for you. How it works: the insurance company provides a small device you plug into your car or uses an app on your phone. This technology tracks your driving behavior, including miles driven, time of day, acceleration, and braking habits. The benefit: if you demonstrate safe driving habits and drive less, you can receive a significant discount on your premium. This is especially beneficial for retirees who often drive fewer miles and during safer hours. 5. Maintain a safe driving record. It goes without saying, but the best way to keep your rates low is to maintain a clean driving record. Avoiding accidents and traffic tickets demonstrates that you are a low-risk driver, which will result in lower premiums over time.